Welcome back. This is Open Exchange, and we are coming to you live from the CNBC-TV18 Motilal Oswal studio. Well, for starters, the SGX is suggesting a bit of a downtick, but it's a good time to get in some derivative strategies. To help us out with that, we're joined by Sneha Seth, derivatives research analyst at Angel One, who joins in. Hi, Sneha. Morning. And first of all, wishing you a happy Women's Day. We're celebrating today, so wishing you a good day and, enjoy it. But we're getting you for the derivative strategy, so please fill us in with what you have for us.
Good morning, Nigel. If we talk about market, last two sessions were quite interesting. We did see a smart recovery after a long time, after that congestion zone which was there. And in last two sessions, there were very interesting thing that is into derivative segment when we saw decent short positions in Feb series and March series as well in the initial part of March series. So that positions have been squared off. And if you see the FI's positioning as well, there also we are seeing that the long short ratio, which was gone down to 15%, has now increased towards 26. Apart from that, if you see the overall data, 17,500 17,600 put options is attracting decent shorts now. So for now, 17,500, 17,600 should be acting as a support. On the upside, 17,800 is the resistance. But I believe we may soon surpass those levels and head towards 18,000. In case of banking index, if we see, we are seeing decent up move. For now, 41,000 will be acting as a support. And on the higher side, we can expect an up move towards 42,000.
What about individual stocks? What are you looking at this morning?
If we look at the individual counters, I'm liking Tata Motors DVR. If we see, we have seen decent, it was trading in a very range-bound kind of a scenario wherein upside there was a hurdle around 225 to 22 zone. So today, I believe we may head above those levels and we can initiate a long call in that counter with a stop loss of 217 and the target will be around 232. Apart from this, we are liking Havells. This counter again has been taking support near 200 is simple moving average and has recovered for now. I believe we may see an upside in this counter as well. So one can go long in Havells with a stop loss of 1210 and a target will be around 1270.
Got that. Thank you very much for the trading calls. And Sneha, you have a great day going ahead. Every day is Women's Day for most of us, right? Isn't it? Thank you very much for joining in. All right, we're just past 9 o'clock and it is time to get our momentumizer of the morning going. An interesting stock which our team picks out every day. Vivek is joining in. And Vivek, you have a really interesting one. This stock definitely has a lot of momentum behind it. NTPC?
Well, absolutely right. It's the PSU power utilities team that's playing out quite well. And, especially we don't discuss stocks like NTPC, given the fact that generally they do not have very strong or very volatile high beta movements. But this particular time, given the fact that you're actually seeing a very strong volume back momentum as far as NTPC is concerned, and some key triggers too that we're going to highlight. So when you're talking about the stock, the price movement itself has been quite strong, up almost 32% in the last year. And from Feb 10th, the stock is up almost 7%, and the stock is trading comfortably above the 50, 100 as well as the 200 DMA. So what's actually the key trigger as far as NTPC is concerned? Similar to last year, the company actually has a very strong correlation as far as the power peak deficit is concerned. So last year the stock did very well whenever the peak deficit actually came higher. Now, along with that, one important trigger is the fact that the government this time around has invoked section 11, clearly indicating that there expects to be much higher demand for power going ahead, and which is why power prices are expected to remain elevated. Along with that, one very important trigger that is expected to fructify before the end of March, the company has actually gone ahead and transferred 15 renewable energy assets from the parent entity to another subsidiary of it, which is known as NTPC Green Energy, and the company has stated to analysts as well as to us, saying that they are expecting to complete a 10 to 20% stake sale at an EV to EBITDA of more than 10 times. That's going to be a very important trigger as far as NTPC is concerned and expected to fructify before the end of this financial year.
All right, thanks a lot for that. So that's on the momentumizers list. But let's talk about the power sector now. I mean, it's, of course, ongoing theme. The power minister has said that they have invoked Section 11 of the Electricity Act to meet the expected rise in power demand. We have Harshvardhan Dole, who's the Vice President Institutional Equities at IFL, who's joining in now to tell us about what this means for the companies as well as, what the way forward could look like. Harsh, thanks a lot for joining in. This, of course, seems to be a proactive step to ensure that there's uninterrupted power supply mainly. But what do you see as the impact that this would have on the companies as well as the listed entities that you track?
See, in my opinion, what the government is trying to do is to ensure uninterrupted power during the seasonally very warm, period of the year. Never thus far has government taken such measures, and to that extent, it prompts seriousness from the government, and which is actually a very welcome step. What also has been done is, in addition to imposing Section 11, creating a separate window for trading peak power, which can be as high as 50 rupees per unit. And that actually bodes well for somebody who's actually having a standard gas-based power plant, who can actually import either a coal or gas and meet that super peak power as and when the states find it prudent. The way we are perceiving, I think for us, power is not a 1 quarter, 2 quarter theme. It's a multi-year theme, which is just at the start of playing off. Power demand is very strong, and there is hardly any incremental capacity in the system. So that places companies like NTPC, to an extent NHPC, Torrent Power, actually in a very sweet spot. Regardless of the run-up in the stocks, we continue to like them.
Okay, all right. Hi, Harsh. Good morning and good to hear your thoughts. So NTPC, NHPC and Torrent Power, we got that. But one stock that's run very, very hard is JSW Energy. I'm just looking at it, in this month, in the last 1 month, it's moved very, very well. And we had the management who told us close to 17-18% of their total sales mix is on merchant basis. So if demand is going to surge up and pricing is going to move up, maybe that could be a potential beneficiary. What's your view on the stock from here on?
So we don't cover JSW Energy, but there is no denying that it's one of the select companies who actually has some merchant portfolio left. And to that extent, it does offer some optionality in terms of uptick in the earnings. But having said that, I'd not be able to comment on the valuations since it's not under stock, which is formally under coverage.
Harsh, let me just ask you a follow-up on your pick, NTPC. Why do you prefer this one over some of the other players if someone's looking to buy a generation company? And how do you look at valuations now, given the fact that even NTPC has moved higher?
Well, NTPC, the reason why we like is threefold. Number one, capacity-based earnings growth. Each year, the company is set to add at least 6,000 to 7,000 megawatt of capacity, which is a combination of coal as well as renewables. And that should propel its earnings at 12% per annum, assuming that CERC doesn't tweak the benchmark ROE norms in FY25. Secondly, essentially the capital allocation has improved markedly. They've been doing buybacks, and the payout ratio in general has been very high. There is a scope for that to improve further, but even if it doesn't inch up, the yield is fairly attractive. And third, most importantly, it's trading below 10 times on FY24. Where could you get a company which has got a great governance, solid balance sheet, and yet available at a peg which is less than 1? So the valuation comfort does exist even when the stock has run up 30-35% over the last 12 months.
Sure. Just a very quick question. Apart from NTPC, what would your top stock picks be? And what is your recommendation on IEX that has had a fair share of a fall in the last 1 year? I mean, it's come off from 250 to now, I think, sub 150 levels.
So apart from NTPC, what we like is Torrent Power. And last week, we put out a very strong note on Torrent Power, highlighting three things. One, this is one company which is trying to grow by balancing the return ratios, cash flows. And that is all backed by a solid governance. And these days, investors are paying a lot of weightage to the high governance within the sector. And to that extent, Torrent Power stands out fairly well. While the valuations are at a substantial premium to that of NTPC and Power Grid, in our opinion, given the fact that the return ratios are one of the highest in the sector and the leverage is one of the lowest, the valuation premium deservingly should continue. So apart from NTPC, we like Torrent Power the most.
Okay, all right, Harshvardhan. We will leave it on that note, a little short on time because we're running into market opening. But thank you very much for joining us and joining in and explaining some of those calls on power stocks to us. Well, the market is not looking bad at all, by the way. Considering some of the regional markets like the Hong Kong Hang Seng are down over 2%, this is not a bad picture at all if indeed this is how the actual market opening and the rest of the day plays out. Just about a 0.25% lower. Banks, of course, are feeling the heat a little more than the other part is the IT and banks. I think that's where pretty much the focus is going to be on as we get set for the open. We have, of course, our technical experts with us. Let's quickly get the calls in. Sudarshan, 910, what's the stock or index that you'd go with?
Well, L&T is a buy. Keep a stop of 50 points from your entry price and then just wait.
Okay, and Mitesh, what about you? What would be the big call at 9:10 this morning?
I'll go with the buy on Coal India with a stop at 218 for targets of 230.
All right, the pre-opening rates are settling about 45 points lower, which is largely in line with what the SGX was suggesting. And it could be a couple of these IT stocks under pressure. HCL Tech, Infosys are down. UPL is also under pressure. And some auto stocks are having it rough this morning. Hero MotoCorp is down about 1%. But some very interesting brokerage notes coming through. So let's go straight to them. Nigel, you're looking at Tata Steel?
Well, that's right. Tata Steel, because Kotak has come out with a note and they have, increased their fair value to around 130 rupees and they've upgraded the stock to buy. Let's run you through the reasons. They believe a risk reward is attractive for the stock and that's why they're upgrading the stock. And in the past 1 year, the underperformance on the stock is overdone. So that's the key reason out there. But there are three broad points. First, on the domestic business, they're saying that domestic steel margins have bottomed out. They should recover to mid-cycle levels in this quarter. That's Q4 itself. And also there are multiple levers in terms of earnings because capacity is coming on stream and that's what could support growth as well as margin. So that's on the Indian business. On the European business, they're saying that there is weakness that could persist in the near term, but they believe that the worst is behind out there. So good news out there. And the third point is on Chinese steel spreads. It remains below mean. So if there's any stimulus that's announced, that could be an additional kicker that comes about. So that's why we're watching Tata Steel.
All right. And Vivek is also looking at the Adani Group stocks. Vivek, over to you.
Well, absolutely. One key worry or one key concern was the proportion of pledged shares in the system. And clearly, yesterday's press release and yesterday's data will surely, give quite a bit of weightage as far as reducing these concerns were there. So Adani Group has gone ahead and paid over 7,370 crore of share-backed financing. And this is to both, international as well as domestic institutions. So there will be a significant amount of reduction as far as the promoter pledging is concerned. Adani Ports, almost 11.8% reduction as far as promoter holding that was pledged was concerned. Adani Enterprises 4%, Adani Transmission 4.5%, Adani Green 1.2%. Now, what the company further says is that there will be a complete reduction as far as the share-backed financing is concerned by 31st March 2023, and that will be the most important trigger to watch out for as this particular group is concerned.
Okay, all right, got that. Thank you, Vivek, very much for the update. In fact, before we get into market open, let's play out some of the snippets from the interview that CNBC did with the man of the moment, Rajiv Jain, and of course his rationale for pumping in over 15,000 crores, not into the companies, but at least in the stocks, and therefore allowing promoters to have some cash with which they're partly at least paying down these pledges.
A lot of the court cases that were cited in the report have all been settled. I mean, one thing which I'm actually blown away is that everybody is paying so much credence to something which actually has been settled. I mean, some of the allegations actually really make no sense. So they can be verified in a number of different ways. So, like for example, the offshore issue. I mean, offshore, Mauritius is the second largest country where the foreign direct investment goes into India. I mean, almost every asset management company and private, on private equity or venture capital goes through Mauritius. That's a known fact. There are 35 million. There are 35 million open court cases. I mean, any company you look at, there probably have hundreds, if not thousands, of open court cases. So the allegations are I mean, that is frankly part of what happens in the Indian corporate landscape. It's very easy to sue anybody. I mean, as I was telling in one of the meetings, that it's easier to sue somebody than buy a bottle of beer in some of the states. If you go back to Adani Enterprise, they got Mumbai Airport in summer of 2020, and the stock immediately started ripping from that. I mean, Mumbai Airport is quite a unique asset. I mean, people forget that this is the middle of the city. They're going to double the capacity overall within the next X many years. And same thing for some of the other ones. So there was deregulation on the power side. In other words, allow them to push through power. The coal price increases. So there are a lot of fundamental changes. Was the stock a bit on the higher side? Probably yes, but there are good reasons why these stocks started running up.
Okay, we're just about waiting for the markets to open, and it looks like the SGX Nifty was suggesting the start will be in the red, and a red it is. The first tick on the index is down almost about 75 odd points. Not a good opening at all for the market, but I guess that was the expectation given that you had a very hawkish Fed outcome, and hence most global markets under pressure. 85 points gone on the Nifty now. The Sensex down about 300 odd points. What's leading it from the front on the downside is metal names. Hindalco, Tata Steel, JSW Steel are all your top losers, down anywhere between 1 to 4 odd %. What's also batting for the bears is IT stocks. So Infosys, HCL Tech are in the red. TCS, Wipro also in the red right now, down about 1 to 1.5%. Banks, the Bank Nifty is down about 190 points now. So all four indices, Sensex, Nifty, Midcaps and Bank Nifty down about 0.5 %. And you have, names like Kotak Mahindra Bank, IndusInd Bank that are your top losers in trade this morning. On the upside, the Adani Group stocks are batting for the bulls. So Adani Enterprises, Adani Ports are up about 1 to 4 odd %. Maruti is a tad bit in the green as well. Ultratech Cement, SBI Life, Eicher Motors. Bajaj Auto has two positive brokerage notes for going for itself this morning. So Bajaj Auto is up about 0.2%. Let's check on Tata Steel. There was an upgrade that came through, so that one as well. But of course, metals in general have been under pressure. So that's the way that, that entire pocket is shaping up. Largely, you'd have to say a weak day for the bulls, a weak start rather. The advanced decline ratio is well in favor of declines. Almost 1,400 stocks on the declining side. Not looking good. Now we're inching to almost a century down on the Nifty. The broader market's also under pressure.
Well, that's right, Sonia. I know we have opened up and we are trading at very, very crucial support zones because of the kind of writing that we are seeing at around the 17,700 put. You don't want to break this level decisively. That's 17,620 to around 17,630 odd. In terms of stocks that are moving around, the Adani Group stocks. Well, no prices for guessing. You have Adani Green. You have Adani Enterprises actually that's opened up well in the green. So that one's bucking the trend. There's going to be some pledge that will be released out there. So those stocks are doing pretty well. Also, just pull up Kirloskar Oil Engines. Nimesh had alerted us there's likely to see a large trade. So we'll wait by to see what are the participants of that particular trade. But that stock should be in focus. This was a bit of an overhang that the street was waiting for. So that's clearly the one that's running away up close to around 7.5% because that overhang goes out of the way. A couple of other names, IGL, well, they're setting up a JV and they're going to be investing close to around 110 crores approximately for a smart meter manufacturing plant. So that stock as well has opened up in the green. Vardhaman Special Steels, well, they're getting additional business coming in from the Toyota Group. So that stock as well is up and about in today's trading session. All Cargo Logistics, they're consolidating their holding in the contract logistics business. And as they told us earlier today, that, that business could give EBITDA in FY24 to around 140 crores odd. So good news on that one, opening up with a gain of around 1.5% odd.
Okay, guys, I'm just getting some context back in that, yes, while this is a red opening, we're absolutely in sync with our neighborhood markets. I mean, this, you could argue that this is not that bad considering the kind of shakedown that you had from Wall Street overnight. Most of the markets, mainland China, Singapore, they're all down about 0.5%. Hong Kong's actually down 2.5%. So given the context, the bulls will probably take it. The question is whether the dip gets bought or whether the bears manage to build momentum on the downside on this opening. And that's going to be the critical question that gets answered over the next couple of minutes. In terms of themes, it's very clear. A lot of the metal stocks are losing their sheen because of the recent run-up. NDTV, by the way, is seeing some pressure if we're talking about some of the Adani Group names. And there's Nykaa. I just wanted to point that out. Nykaa was down on Monday as well because of adverse brokerage note. There's some more selling on that one. Even Zomato, when it first popped up on my screen, was on the downside. So just some names which are catching the eye this morning. Otherwise, the market's just holding that level of about a 75-point decline on the Nifty. The Bank Nifty is actually doing even better now. The decline is less than 0.5% on the Bank Nifty. So the big question, was this the one knee-jerk reaction to Jerome Powell, or is it the start of obviously a longer period of repricing the reality? Well, we have Arvind Sangha, who better than him, who's actually with us in Mumbai, here in the studios with us. Arvind, great to have you in. So let me ask you that question. I think that everyone's wondering. It's not like the market didn't know this, but Mr. Powell has only reiterated and confirmed what everyone's been talking about. The rates being higher for longer, sort of a theme. But you tell us, does it mean equities need to reprice down further, or is this going to become a bargain hunter's market at some point?
Well, so let's separate India from the global markets, right, and the U.S. And let's just talk about from a U.S. context, and then let's come to India because, you know, we need to contextualize it. I think the hope that was growing in the U.S. till about a month ago was Goldilocks, soft landing, there would be no recession. And I have been consistently skeptical of that view. In your last, I think a couple of weeks ago when I was there, I talked we might get to 6%. That seemed far-fetched even 2 weeks ago.
Yeah.
And after yesterday's testimony, now people are talking about 5.75, 6 is around the corner. So I think that the reality is that the inflation is proving, and this has been my consistent theme through the last 6 months, that inflation is going to prove to be more persistent. The easy goods inflation came off, but the other elements of inflation are more sticky, the services, the labor, whatever. So therefore, Fed is going to have to hit the brakes harder. And I think somehow the hope has been that, you know, that we can escape without pain. There is no way, in my opinion, that the market in the US, and this may apply a little bit to global markets, can bottom before a US recession has even begun.
Oh, okay.
That has never happened before. So you have to be very careful about saying this time is different.
Yeah,
But the
okay.
market was always, you know, till now, having the view, as you said, the Goldilocks, oh, it'll be a mild recession. It won't exactly, you know, derail everything. And equities were trying to chug along. Does that change?
Absolutely. Well, you know, mild recession was still not the central case. The central case was no recession. And that rolling recession, we had some 1 or 2 quarters of negative GDP growth, but earnings will stay high. S&P earnings will be fine. So I think that all of that has now changed. And so I think the challenge for emerging markets, so India's had 3 headwinds. Now let's talk about India. India's had 3 headwinds, the global Fed tightening. You've had the China repricing up, which has caused flows to, you know, get reoriented, and you had the Adani meltdown. Now, of the 3, the Adani worst is behind us, and I think in the long term, I will make a controversial comment that I think what has happened with Adani will be long-term beneficial for India, including India infrastructure. You do not want a private monopoly controlling significant chunks of the infrastructure, and I think there are signs that this will be healthier for long-term India growth. So I'm actually more bullish on India now that we've had whatever needed to happen in terms of, you know, repricing that situation. So then we come back to the other. So the U.S. Fed story is still a negative. The China story is looking like China is continuing to disappoint even in its reopening. The reopening has happened, but from the statements from the NPC over the weekend, it's clear that they're taking a much more measured, slower opening approach. So that puts the risk of capital rushing into China from India, which had happened for 3 or 4 months, that is behind us.
Okay.
So then the third thing is, I think, the India growth story. And I think the India growth story is not dependent on US Fed rates.
So, you know, by the way, it's great to have you here in our studio. And what brings you to India?
Oh, just coming and visiting companies I hadn't been in a while, so it was overdue.
And have you had those visits already? Any key takeaways from the ones that you've met?
Not yet, because just Monday was my first day of meetings, and then, you know, I'm doing more in the next 3 days. But the impression I have from the people that I've talked to in the last few days is that, you know, look, the fourth quarter GDP, the fiscal third quarter GDP was disappointing. There's no way to put our, put a soft point on that one. But I think if we look at where we are in terms of the growth story, the legs are there. Whether it is the, China +1 outsourcing or other elements of business confidence in the U.S. I mean, in India returning. Yes, maybe the IT companies and others have to worry about a U.S. recession more, but there's enough domestic facing. And there's been a lot of innovation in India that we don't appreciate in terms of the payment system and other things that give, friction. The main problem in India has been friction of cost of doing business, right? Whatever we call ease of doing business, a lot of it is friction. And if this government continues to do the right things, and I'm, hoping that some of the things that were rolled back, that if, in addition to the PLI scheme, further moves on labor, farm, all of these, I know they're controversial before the 24 election, but I think over time, I'm hopeful that we'll continue.
But if you're so bullish on the India growth story, do you reckon that even if there is a not just a mild recession, but even if there's a full-blown recession in the US, India could still sort of manage to emerge unscathed?
I don't think India emerges unscathed. So I talked about three headwinds, right? So the China headwind is gone, but the US Fed recession risk headwind, India is not completely divorced from global growth. So in that sense, that headwind will remain. So looking at more domestic-facing companies, in our opinion, is a better way to play the India story than the global story.
All right. Hi, Arvind. Good to have you in the studio. Arvind, how are you handling the heat? Isn't it quite hot out here?
No, I actually moved to Miami a year ago, so it's quite comfortably similar.
I ask you that because I recall the last time you joined us, when you were talking about the terminal rate at around 6%, you also highlighted that the power sector in India could do pretty well.
Yes.
And that's played out actually quite well in the last, I think 20, 30 days or so. We are seeing a lot of buying on power names. Do you think that's a good theme for India? It fits in with the scorching summer that we're bracing for. It also fits in with the domestic theme. And Fed tightens or not, that sector could be in focus.
Power.
Yeah, absolutely, absolutely. We think that that it's a real challenge, and it's kind of a common. We launched a fund in the U.S. which we call Sensible Energy Transition Fund, and I think part of what happened is that the whole world, and India was no exception, has jumped too quickly on the renewables bandwagon, forgetting that the sun doesn't shine at night and the wind doesn't blow when expected. And so I think what you're seeing is that the challenges of power, especially if you see the peak pricing of power in the power trading markets in the morning before the sun comes out, and in the evening when the sun goes down, there's ridiculously high prices. And I think that's speaking to the reality that India is going to have to reinvest in thermal power generation. I realize we have all these, zero carbon goals and all this carbon reduction, but the reality is that you cannot have an economy prosper without energy, and you cannot make the sun shine on demand at night. So therefore, there is no choice, because the cost of battery storage is not economic versus India's needs.
So underinvestment in the thermal power plant space that could, still present a big opportunity for some of these parts.
Absolutely, absolutely.
Okay, that kind of brings me to the next question on my mind, Arvind, and that is government capex versus the private sector. So we've been having this elusive conversation about when the private sector is going to move and capacity utilization levels at 80%. And we're still waiting for that. What has, of course, kept the market in high spirits is government capex. And we've seen that play out not just in some of these power companies, but in stocks like ABB, Siemens, railway stocks, defense. Do you see that needle shifting towards private capex? If yes, how should portfolios gear up for it? First of all, do you think it's needed at this point at all, or should you just stick to some of these government capital expenditure themes?
I think for the long-term efficiency of the economy, let's be honest, there is no way that government capex is as capital efficient as private sector capex. So from an economic growth long-term, let's forget for a moment the short-term, you need more private sector capex. That's what is done efficiently. I do believe, whether it's cement or it's steel or it's other sectors, the capex needs are there. Even in power, it's not all going to be NTPC only, right? There's going to be required to be some private sector investment. So I would think that in terms of the long-term, even medium-term, I would make a bet that private sector capex is coming. It won't come all at one shot. But
just on power, since you're positive on the sector, how do you deal with the fact that your returns are regulated? It is a regulated sector. So how do you navigate that? Do you play something else in the chain, or is there simply no way out?
Yeah, I mean, it is always challenging in India. We have made a lot of money in investing in coal companies around the world. We own Coal India, but Coal India is not able to benefit from, they're selling coal at less than $20 a ton, and you can find companies globally selling at $200-300 a ton. So, you have those challenges in India, but, whether it's an NTPC or an NHPC or others, there are opportunities in the power sector, but we are looking at private sector companies. There are a few, and seeing which of them, whether it's in the power trading business or it's in the, private sector, JSW Energies and others. There are opportunities in the private sector power, but a lot of companies have gone bankrupt over the years, so you have to be careful where you put your money.
Okay. Arvind Sangar, always great speaking to you, whether it is in our studio or remotely. Thanks a lot for joining in. Hope we have more in-studio, meetings from you, and thanks for your thoughts as well. Have a great India trip.
Thank you. Appreciate it.
All right, well, that's the market, but let's talk about the big deals that have happened in the banking space. Axis Bank last week sealed the deal to acquire Citi's consumer business in India for 11,600 crores. This move brings 3 million Citi customers into the Axis fold. To discuss in detail on this deal and their business outlook, we have Amitabh Chaudhary, the MD and CEO of Axis Bank, joining us now. And we have Lata in the studio as well to take us through the discussion. Mr. Chaudhary, before I hand it over to Lata, congratulations on this deal going through in entirety. Just wanted some, details on the way forward. Now, you would have allocated about 11,500 crores plus about 1,500 crores of integration expenses. So on this 16,500 crores in total, can you tell us when do you expect to generate that 18% ROE that you had spoken about earlier?
Well, when we had bid for the deal, obviously we had gone through all these calculations. Citi franchise is a 120 years old franchise, and an affluent franchise of this caliber is not an offer for sale regularly in any marketplace. And it would have taken many years for Axis to build. So this, we believe, is a once in a lifetime opportunity. The valuations, whichever way you cut it, at 17.7 to 18.7 times profits remains very, very competitive. If you look at similar listed businesses in the credit card and the wealth management space, which is the big part of what we're really buying, it will be obvious to everyone that we're not overpaid at all. Actually, our prices are very, very much in zone of what the kind of market caps of some of these companies are. Even though the Citi deposit franchise is only 4.5% of our franchise, I think we should note that it accelerates our journey, improving the quality of the overall combined liability franchise of the two entities put together. It's clearly visible with 10% improvement in our CASA market share. We will improve our overall CASA ratio by 1.5% and so on and so forth. So, I mean, I can go into more details, but at a summary level, I do want to say that the deal is well priced. If you look at, similar rated companies in the marketplace, if you look at what the opportunity is in terms of the synergy benefits we can derive from this franchise, we've already identified 60 various initiatives, which will obviously intend to work on over the next 12 to 18 months. We can take Axis products to Citi customers and some of the Citi's best practices to Axis customers. And we believe that the combination of two will add a huge amount of value. Also, please understand that there are a huge amount of cost benefits that can come to us through this deal, because the Citibank franchise was being obviously debited with global costs, both for the corporate overhead and technology support. You mentioned the 1,500 crores as the amount of money we'll spend in transition. But once that goes away, the benefits we can get in terms of reduced costs also will feed into the overall profitability of the franchise. So we are very delighted. We are also delighted by the fact that we closed the transaction 1 month earlier than what we had anticipated. 97% of the employees have come into the fold of Axis. I think the initial feedback I'm getting of the first day of their joining, which was March 1st, is extremely positive, extremely good. I think both the teams from Citi and our side worked very hard to make it happen. A lot of work left, a lot of execution left, but the first steps have been quite positive, and I'm quite hopeful that we'll be able to continue to execute well as we move forward on this deal.
Oh, of course, Amitabh, it would be great. After all, so many people vied for that piece, so it should be great to have it. But, you all were looking to see how many people will stay back at Axis, and I believe there is some 19% fall in cards, 33% in the wealth AUM. Now, does the 6% fall in the cost that you were given measure up? Couldn't you have got a little more in terms of a cost cut?
So, Lata, very, very fair question. So I'll give a slightly longish answer. Just bear with me. Firstly, we've been consistently communicating the day this transaction happened that we expected natural attrition in the numbers due to the extended period from divestiture announcement by Citi of its India consumer business and closure of the transaction. So they announced it in April 2021, and we have closed the transaction on March 2023. There was obviously also a requirement for express consents across liability products. So only on the express consent of the customer, they have been migrated to Axis. And obviously there is a change in business cycle from diligence period to closure. Please recall that when they shared the data with us as of June 2021, India was just coming out of the Delta wave of COVID. So the deposits in the system were high. So when we bid for the transaction and when we kind of applied a price to it, we had taken all this into account. We had taken into account attrition, we had taken into account the express consent. So firstly, the price builds in all this. We have taken two-pronged approach to correctly address this aforementioned risk. We factored the above upfront in our initial valuation and bid. And to protect ourselves further, we built a price adjustment mechanism as part of the transaction. So what you're seeing is that the upfront valuation had an attrition built in, and then over and above that, we had a further protection, and that protection has led into a lower price for us. But just to give you a sense, the portfolio quality has remained strong because express consent is built in. There is 36% improvement in average monthly spends per credit card in January 23 as compared to June 21. Similarly, on the deposit size, average deposit per account improving by 13% over the same period. So indicating that what we are onboarding, even it's an affluent franchise, we are onboarding even a further affluent part of the franchise into access. So we are happy with where we are. I think it's very much in line, as we have been consistently saying through this transaction, that's very much in line with what we expected. And that's where we have ended up.
Okay, no, that's a fair point. It's express consent, so that's very big. And it's super affluent, I would assume. So that should mean more returns to the bank. But your capital goes down to 13.8% from 15.6, right? Of course, way above the regulatory requirement. But will you be raising capital sometime soon, like in a year?
So we have been... we don't need any capital to pay for this deal. This will be funded entirely from the existing balance sheet. Our capital adequacy position remains strong. So as of December, 2022, we were at 19.51, CAR, which is capital adequacy ratio, and CET1 ratio, which is what people focus more on, was at 15.55%. We have net accreted 31 basis points of CET1 capital in the first 9 months of this year. So the purchase consideration and the assets required will consume 177 basis points of CET1 capital. So we'll end up at 13.78. Given our operating performance and post-acquisition capital position, we believe we have sufficient capital to fund organic growth of our existing and acquired business for a period. We have significant amount of flexibility. And I want to say it very categorically, we are in absolutely no hurry to go and approach the markets anytime soon.
Okay. What about Bain? You heard anything from them? They are not trying to cash out or anything, are they?
I cannot speak on their behalf. The only thing I can say is that the Bain, when they did the transaction with us, had a right to be on our board for a certain period of time. That right expired last year. We have extended it further because they wanted to stay on the board, and we believe they were contributing at the board level. Beyond that, they have the right to sell. And if their shareholding comes down below a certain level, they obviously lose their position on the board, but at the end of the day, they are a venture capital firm who needs to provide a return to their partners. So we fully understand and appreciate it. So kind of ultimately, it's Bain's call.
Of course. Well, to come back to the major business, right now you will have to report a loss, right? Because of the write-off of goodwill for Q4?
Yes, you're absolutely right that as we have again consistently disclosed that we will take a one-time charge to the P&L in this quarter, goodwill and other intangible prudent amortization, policy harmonization costs and provisions, and implementation expenses. So there will be a one-time impact. See, now I just want to emphasize policy harmonization costs and other prudent provisions are largely non-cash and prudent. It should not be automatically implied that this will result in an economic loss to the bank. These are just provisions being created. Absolutely. Also, it is pertinent to note that the extent accounting standards permit amortization of goodwill and other intangibles over a period of time. We, as an institution, have decided to amortize this 100% in year one because we believe that is the right thing to do and enables the bank to retain operating flexibility like payments of dividends, etc. So we are taking a more conservative approach. We intend to write it off at one go in this quarter and look forward to obviously focusing on getting the value out of this acquisition over a period of time and as quickly as possible.
Okay. I read several analyst reports, and the crux is that they have cut your current year's profit by 50%, obviously because of your upfront amortization. But people are raising your, they already have built in a profit growth, but they've raised it by between 3 and 5% because of the deal. Fair point, fair analysis?
Well, our initial current estimates of 800 to 842 crores of profit of the city business, which we gave in March of last year, we have maintained it in spite of, you mentioned that in some cases the business has fallen or size of deposits has come down. We believe that firstly, the business inherently remains that profitable. Secondly, we are working on cost and revenue synergies. And we believe that over a period of time, they should help us to increase profitability of the combined franchise. So yeah, I mean, people obviously are looking at our statements. We are normally quite conservative with what we say. And we have just said that we maintain the 800 to 842 crores profit of this franchise as it stands today. Obviously, the 60 plus synergy benefits I've talked about, if they play out and they play out well, the combined profitability of the franchise will go even further.
Okay. Well, just to come back to the main business, there is, of course, an expectation that our Reserve Bank is likely to raise yet again in April. And, of course, global rates, Powell is talking about not just higher for longer, but probably at a faster clip. So even if 50 bips can't be ruled out. Will NIMs peak off?
So, Lata, if you recall, whenever I've talked to you, I've always said that the macro is too volatile and what we believe today seems to change tomorrow. So if you recall, just a couple of months back, all of us were saying, okay, rate cycle is coming to an end and things are going to look positive from here. Look at how things have changed in the last couple of months. And I think as financial institutions, as an economy, we have to be very, very cautious because a lot of things are not in our hands. And you referred to the statement the Chairman Powell has made, and he seems to be talking about rapid hikes and larger hikes, because inflation is just not going away. And you're hearing the same statement coming from, Europe too, that where they're talking about, further hikes, and they're saying that inflation is just taking time to go away. So my worry is that obviously it will have an impact on India. And if beyond a certain interest rate, India's GDP growth rate potentially could get impacted. So we have to be very, very watchful. We have said, as far as NIM is concerned, now coming back to the question which you have asked, we have reached an all-time high on our NIMs last quarter. And that has been after, obviously, a lot of effort from our side. So we reached 4.26, growing 73%, 73 basis points year on year, and 30 basis points quarter on quarter. Now, we do expect liability and deposit costs to increase over the next few quarters, with limited compensation from asset repricing. We have always guided the market that we would like to have our NIM above 3.8%, which gives us a cushion of 41 basis points over our structural medium-term NIM expectations. Our endeavor, having reached where we have reached, will be to ensure and work towards retaining as much of that cushion as possible. There are two of the three drivers on NIM journey, which we have an ability to control and should serve us as some offset to the rate pressure. And they are the product mix, within the product mix of wholesale and retail, which are some of the assets we can push. We still have a pretty large RIDF portfolio. We can work on ensuring that the outflow on our deposits continues to come down. So we have some levers we can work on. So on one side, while there'll be deposit repricing, on the other side, we are hoping that we can continue to work on some of those other factors and variables and ensure that this cushion is maintained or kept as much as possible to close to 41 basis points as where we stand today.
Okay. Just one follow-up, Mr. Chaudhary, there. How much do you think the margins will fall in Q4 since deposit rates have gone up so much?
You're talking about the loan growth?
No,
margins.
Margins. Yeah, so I'm not commenting on the margins at all. Let me repeat what I'm saying. We are at net of one-off, we are at 4.21%. As a bank, as an institution, will work very hard to maintain this 41 basis points cushion, that is above 3.8%, and try to keep it in that zone as much as possible. Where will we end up with? Wish we knew what was going to happen tomorrow. We still have quite a few days left in this month. A lot of advances and disbursements do happen this month. So let's wait and watch, and in April, and we'll share with you as to where we end up.
Okay. All the very best, Amitabh, for this deal and for the coming years. We will take a rain check with you for a more thorough interview later. This one was consumed by Citi. Thank you very much.
Thank you. Thank you so much, Lata. Always a pleasure. Thank you.
What do you say?
All right. Thanks a lot, Lata, for joining in. And that's Amitabh Chaudhary talking about the Citi deal and the kind of expectations that he has from the overall business and the industry going forward. Let's slip into a quick break. When we come back, we will be speaking to the management of CAMS. Anuj Kumar, who is the managing director of CAMS, will discuss their acquisition of a little over 55% stake in Think Analytics. And later in our special segment, Charting Trends, Mitesh will join in to help decode the technical trends of the market for the slightly longer term. We'll talk about some stocks as well. Do stay tuned in for that.